I'm going to be discussing the most recent CPI data from this week, and where the Fed can pause the rate hikes. Price pressures remain high, but I think the gradual cooling sets the stage for the Fed to downshift the pace of rate hikes further. What will happen if the Fed pauses to the bonds and the stock market? Welcome to Take It Easy Trading, your channel to get stock market updates, trading levels for popular ETFs, stocks and Bitcoin. You will also find tutorials on how to trade, develop your own trading strategies and learn continuously. Please like, share, comment, and if you find value in my videos, please subscribe to get notified of new content. The year started with stocks rising, bond yields falling, and the US dollar weakening, a mirror image of the trends that prevailed in 2022. To validate the persistence of these better market outcomes, or to dash such hopes, all eyes were on the December inflation reading. And the data did not disappoint. It matched consensus expectations, which was a small but necessary step towards easing some of the pressures. Highlights from the December inflation report. 2 is a coincidence, 3 is a trend. The Consumer Price Index, CPI, decelerated further, with December marking the smallest annual increase since October. Paired with the November and October data, core inflation, which excludes the volatile categories of food and energy, has now slowed for 3 consecutive months. The graph shows that core CPI and the Cleveland trimmed CPI have now slowed for 3 consecutive months. And so have other measures of underlying price trends, like the Atlanta Fed's trimmed CPI, suggesting that a pattern of disinflation is emerging. Headline inflation fell 0.1% from the previous month, helped by a decline in energy prices and a more modest increase in food prices. Annually, CPI was up 6.5%, decelerating from November's 7.1% pace. Stripping out food and energy, core consumer prices increased by 0.3% last month and 5.7% over the last year, almost a full percentage point below its September peak. Goods inflation declined for the 3rd straight month, driven by the 6th monthly decline in used car prices and the first decline in new car prices in 2 years. As supply shortages continue to fade away, shipping costs fall, and consumer demand moderates, expect goods prices to deflate further. Services inflation ticked higher, as shelter, the biggest component of inflation, accounting for about 1/3 of the overall index, increased the most in 3 months. But I doubt this strength will last for long. New leases and home prices tend to lead the shelter CPI by several quarters, and both have been declining in response to the spike in borrowing costs. It might be later in the year, but housing inflation should start moderating, as suggested by the more timely data. Home prices suggest shelter inflation will roll over later this year. The graph shows that shelter inflation tends to lag the change in home prices which have already rolled over. Path forward. More signs that disinflation will be a key theme in 2023. Evidence continues to build around moderating inflation. The CPI trajectory over the past 3 months, together with the signal from leading indicators of inflation such as the ISM prices paid for inputs by manufacturing and services firms, indicates that core inflation could fall to 3% by year-end. The path of disinflation is unlikely to be a straight line and will require the labor market tightness to ease. But even with the ongoing strength in job creation and historic low unemployment, wage pressures have started to moderate. Will the Fed pause rate hikes? Just a quick note. Don't forget to watch my new videos on trading strategies. I outlined how to use the RSI indicator, stochastic indicator and some great trading strategies that will help both the beginner trader and an advanced trader. Too soon to declare victory but not too soon to consider a pause. Last week's data support another downshift in the pace of rate hikes to 0.25% when the Fed meets on February 1st. Consistent with this view, market probabilities for a quarter-point hike jumped to 97% after the CPI reading. One additional and final hike potentially in March would then bring the Fed funds rate to around 5%, matching market expectations and Fed projections, at which point the Fed can pause to evaluate conditions. Inflation remains well above the Fed's target, so policymakers are likely to continue pushing back against expectations for rate cuts. But they are likely to gradually soften their tone and signal the end of the Fed's most aggressive tightening campaign in 4 decades. How do markets perform when the Fed pauses? Over the past 40 years the Fed has paused 7 times after concluding a tightening cycle. Following the final rate hike, policymakers held rates steady for about 6 months on average, ranging from a month to a little over a year, before proceeding to cut rates to stimulate the economy. Stocks performed strongly in 5 of these instances, while they declined only modestly the other 2. Investment-grade bonds also experienced above-average returns, as yields peaked a couple of months before the last rate hike. Likely benefiting from the easing in yields and financial conditions, technology was the best-performing sector, with the exception of the Fed pause in 2000 that coincided with the tech bubble bursting. History suggests that a Fed pause can be a catalyst for lower bond yields and higher equity valuations. This is consistent with my view that balanced portfolios, like a 60-40 stock-bond mix, are poised for a rebound after a historically tough year. More headwinds ahead, but worst-case outcomes likely avoided. Investors have gained more confidence that the inflation tide is receding, helping sentiment stabilize. But as inflation data now match expectations, markets might need some further fuel to continue to march higher. That dynamic was evident in the muted reaction from stocks following the CPI release. As the year progresses, the focus is likely to shift from inflation to growth. Recent economic data have stayed resilient, though the Fed's aggressive rate hikes will likely hit the economy with the lag. That is the message from leading economic indicators, such as the inverted yield curve and the decline of manufacturers' new orders. With activity likely softening in the months ahead, corporate earnings could come under pressure and be an instigator of volatility. Investors got a small taste of that, as U.S. banks kicked off the 4th quarter reporting season last Friday. For the quarter, analysts expect earnings for the S&P 500 to have declined 4% from a year ago, the first decline since the 3rd quarter of 2020. The silver lining is that any earnings weakness may already be priced into the market, reflected in the outsized decline in valuations last year. Lastly, a recent string of better news from abroad argues against the potential of a deep global recession. Mild weather has helped avert the energy crisis in Europe this winter, resulting in softer inflation and better than expected economic data. The graph shows European natural gas prices which have recently declined to pre-Ukraine war levels. In response, European equities have gained about 6% halfway through January, the best start to a year on record for the region, and outperforming the US market since September. At the same time, prospects for China's growth have brightened, thanks to the expected economic reopening as the country pivoted away from its zero COVID-19 policy, while measures have been announced to support the property market. The bottom line. It is not yet clear if the bear market in equities is behind us, but, in my view, the worst of inflation is. This means that the Fed can take its foot off the brakes soon, potentially relieving the upward pressure on bond yields and equity valuations. Amid less aggressive Fed policy, slowing economic activity, and disinflation, the backdrop for high-quality bonds has improved. Equities could stay volatile in the near term, but I think investors can start preparing for a more sustainable rebound in the second half of the year by diversifying into cyclical sectors and the quality parts of beaten-down tech companies. I hope that you enjoyed this video. If you like this video, don't forget to hit the like button, so I can get motivated to make more such videos. And if you haven't subscribed to my channel yet, please subscribe, and turn the bell icon on, so you're notified when I drop a new video. See you in the next one.